knew I had to. Yep, pulled that red shirt out, and we're back at it. A little fun with you. Some of you said, is it going to be red shirt day? I think Friday we wore it. We talked about maybe a little weakness, and we talked about exiting and stop adjustments on Monday. And we talked about neutrality of price action yesterday. So we're just having a little fun with you. All right. Now, just real quick, today's class called Trading Growth and Value. That does not mean you can't trade income. But most of our examples will be growth and value. Typically, sometimes we might even talk about income examples. Now, we also have Ben Watson with us in the chat. We welcome him. And also, we'd like to welcome all of you here today. We got Lawrence, Josh, Bill, BJ, Grace, and many others. Welcome to all. Let's go ahead and hop right in. Now, remember, the information here is provided for general informational purposes only. Should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. What I show is like a buffet, okay? Some of it might interest you and others, maybe not so much. That's okay. We all have different preferences, right? And also different things that we feel like it might fit us better, okay? Schwab does not recommend the use of technical analysis as a sole means of research, so we do a class like this on fundamental analysis to kind of really get a different perspective. Also, we will be using the paper money software application known as the desktop. When we talk about, or if we talk about, let's say, stocks that pay dividends, they may reduce or stop paying dividends. What that doesn't say is they could also increase it as well. So I understand that. And also, when we talk about examples, when we talk about stocks, and we'll just keep it to stocks. Stocks involves risk, including loss of principal, past performance, no guarantee of future results. So what I want to do is just take a quick look at the market, and then we're going to spend the rest of the time on examples. Today, my overall, the theme of what I want to talk about is kind of building a portfolio when the volatility is up. Now, that is so counter, okay, to what you think, because if the volatility in the market or the market is going down, okay, volatility up, market going down, that's usually not a time that people would think about maybe setting up a portfolio. I want to push back on that, okay? And so we're going to talk about that here today. Now, first thing what I want to do is I want to pull up just kind of where the market is, and I'm going to use the market kind of ticker that we'll look at here, just the good old SPX. This was our upward channel that we had. And the last, let's say, 2 days or so, we've been kind of below, said this yesterday, when you're looking up, if you were the price and you're looking up at the moving averages, you've lost momentum. You lose momentum, price tends to fall down, okay? And today, the follow through of that, down about 50 points or so, down about 0.9%. When we go back and kind of take a look at kind of where these levels might be as far as bounce areas, 5070 or so, 5770, another bounce area about 5700. So far, not really dramatic. Kind of just more of a slight pullback so far. We did not see the Russell hold the level that we had. We saw it break down below that 2228. We said if we fall down below the 2228, the path of least resistance is you could fall back down near the bottom of the channel. Russell almost went to the bottom of the channel here today. So notice the market is not as fun when you see the shorter term moving average have a red line on its moving average. Red line, red, red, red. Not as fun. It's kind of almost like it's raining in the market. The moisture or the rain is really price dropping. Okay, not as fun. However, if you're looking to kind of get in, you're kind of hoping that it drops down to an area that you might want to try to get in at. Now, when we take a look at the NASDAQ, which had been holding up better, we saw that really take a pretty good drop here today. The semiconductor, better drop, 1.5%. Semiconductors also on thin ice as well. Kind of been ugly, at least on the semiconductors. Overall, NVIDIA hasn't been that bad, but when you look at the group in general, hasn't been that strong from a group perspective. Dow Jones, you pull that up, we've dropped down. There was a cross yesterday that happened. The 20 period moving average went red as well, and you're going to see that we just dropped, and we've now cleaned the decks back down to where we broke out from. Technically not completely unusual, but that's kind of the systematic breakdown. Thing that I always want you to kind of look at is if the 10 period moving average goes red, you're losing momentum. Okay, it's like an airplane. Usually if you lose that momentum, the altitude is you're dropping. Okay, and you tend to drop down to the floor of the ground. And if that momentum drops, and if that price cannot get back above that 10-day moving average line, you can get a crossover, which happened, and you can also, if you keep losing altitude of price, you get the 20 period moving average to kind of confirm the price is dropping, which is kind of saying the trend is eroding a little bit. Now, one thing is when you take a look at the volatility, little bump on volatility here today, okay? When you look at, let's say, the interest rates, which is going to kind of come into our discussion, those interest rates are at 4.23. Now, in the world of investing, it's not just stocks. Let's not kid ourselves, okay? What other things are there outside stocks? Let's just make sure we're all on the same page. So, wait, let's think about this. Okay, if stocks aren't going up, what other opportunities are out there? Well, there's things like fixed income, okay? There's also, for example, things like futures, okay, tomorrow morning, 9:30 a.m. Eastern. There's things that, for example, will try to take advantage of that price movement, actually the yield or the price. And then when you bring up, for example, the U.S. dollar, which has been amazing, okay, when that U.S. dollar goes up, that means some other currency is going down. And some people choose to play that. So I think it makes sense to kind of broaden the funnel of your understanding. Sometimes stocks, they're not bullish, but other areas might be. And then we would include, of course, if you bring up, let's say, gold and silver and some of these others that have been quite strong as well. So don't think that just, if I'm building a portfolio, I have to have just stocks. You might look for other things to complement a stock portfolio, okay? Now, what I want to kind of touch on just briefly, and I want to kind of give you a little quiz. So here we are in the IRA account, and I want you to tell me what looks a little different on this account that we have normally not seen before. I'll guide your eyes here, okay? So if we were to kind of look at this column, tell me what you see looks a little unusual that we haven't seen for a while, okay? Well, I mean, if we looked at the background color and we looked at the number, we see a lot of fives. 5, 5. What in the world is 5? Okay? Is that a good thing or a bad thing? Well, it's more of what I just said, right? Which is just showing, and let's write this down, and I'm going to do this fast, which is if I went 1, 2, 3, 4, 5, okay? What is 5? This is where the price falls below 10-day EMA. 10-day EMA, you might be using whole. Well, we could talk about both. But still above 30. The major point of this is losing momentum. Now, what does this probably mean? It might mean exits. And as Ben talked about this morning, some investors might say, James, I'm going to enter protection. Okay? Now, you might not set stops. You might not manually get out. You might not even use option derivative protection. That's up to you to decide. Now, remember, 5 and 2, so 5 is bearish momentum, okay? And which one is bullish momentum? Well, 2 is bullish momentum. 2 is break resistance. And 5 is really breaking support, okay? So if you look here, you say 5, 5, 5, the investor says, well, geez, what am I probably going to be doing in terms of trading? Well, like we talked about on Monday, exits, setting stops, stop adjustments, and using options as a way to protect her, potentially, if you want to consider that. So we always try to bring up things we talked about on Monday, which might be helpful to start the week. Kind of a timely discussion, okay? Now, I want to kind of bring up this point, okay? So let's say the market is falling down, okay? The market is falling down. This represents the good old SPX. Does everything drop? I mean, are there opportunities when the market drops? What might the opportunities, what could they be? Well, if the SPX is going down, we know that the VIX is probably rising. So think about the VIX. If it's rising, the blood pressure of market participants becomes a little bit more fearful, okay, or defensive, okay? They're concerned about protecting capital and or unrealized profits. Now, when the SPX actually goes down, some investors might focus a little bit more on what we call income. Now, where are those areas of income? Now, when I say income, we're really saying what areas might be, maybe perhaps be paying dividends. Now, so we're talking about divs, okay? When we also say income, we also might be saying at the same time which companies might have more stable revenue, more stable earnings per share, less cyclical, meaning it doesn't go up as up and down as much as maybe everything else. We also might say a lower correlation to what the S&P is doing, known as beta, okay, lower beta. And so these areas are probably going to be your U for utilities, V for healthcare. I'm going to label R for staples. And I'm also going to put in here RE for, let's say, real estate. Okay. Now, let's say the investor says, look, I ain't got squat. I ain't got even a portfolio. We're in a situation where the S&P is pulling back. VIX has gone to the upside. What might kind of be the first way to, let's say, build a portfolio? Well, one of the first ways, if that's the condition that we're in, okay, if we're in that condition, the investor might say, James, I want to kind of create a bed of utilities, staples, healthcare, and maybe real estate stocks that are maybe more, they can be traded, okay, they can be, but they could also be potential investments, okay? Now, I want to kind of bring this up, and a couple examples. I think if we said, well, what did we notice today in terms of, and this is a question, what industry group did you notice that was just like predominantly up today? What industry group? That goes along with our drawing, okay? Now, I think we would have to be like, if you say, I don't know, you didn't look, because the pattern was so obvious, you could close one eye and still see it. I mean, the industry group that pretty much was, well, there's two of them. It was utilities and it was real estate, okay? Now, what I want to do is I want to kind of talk about kind of putting some trades and or investments together, okay? Now, I want to go back to example given like knee, okay? Now, here's what I'm going to tell you. I also want to kind of talk about this in terms of what happens if you're investing in pockets where there's higher volatility. Well, when investors kind of see that there's more volatility in the marketplace, they might do dollar cost averaging, okay? Now, one of the ways to kind of do dollar cost averaging, I'm going to show you this, and we're going to let it rip here. Some people will use the ATR as a way to do dollar cost averaging. Let me show you a couple examples, okay? So this is a company, knee, that already went through the earnings. The stock today rallied to the upside, and it's kind of right up against resistance again. Now, down at the very bottom of my chart, you're going to see ATR, which stands for average to range. Think of it as the dollar amount movement on average from low to high over the last 14 trading days. So how does someone use it to dollar cost average and to build a portfolio and higher, maybe a little higher volatility? Example given. So I'm going to go back to our sheet. We're going to look at, let's say, the stock we're going to look at is knee. The current stock price we're looking at in this case is, what do we got? It's 84.96, okay? So when markets are more volatile, people become fearful to trade what they see. For some reason, people think, well, I got to get in the whole entire position. Nobody ever said that, okay? Nobody ever said that. Now, what I'm going to do is, if we go back to this, what is the ATR? Well, that ATR is sitting right at 160, okay? Now, I'm going to kind of show just half an entry, and I'm going to put, for example, the other half later, And I'll talk about what later means. So if we say half entry, we're talking about now. And if we say now, we're talking about 84.96. Okay. Now, when we look at that ATR, we're asking ourselves, well, what is that ATR? Well, it's about 160. Okay. And if I took 160, how are we using that? Well, what we're going to do is we're going to get in, and then we're going to add another position if the stock goes up, another ATR from our first entry. Now, wait, what? So why do you do that? Well, because when there's more volatility, it's price going up and down. And the investor might say, look, I want to make sure that I don't get all the full position in at once, only to see the price go down and then not have the capital to buy in at maybe a better level, or maybe a level that you might want to try to get in at. Now, this initially is only looking at if it were to go up. So if you get in the stock and it doesn't go up, you only have a half position. Now, if we talk about the stop, or I should say in this case, let's go to support. What is the support on this? Well, if I said to us, say, I think support is maybe 884, or if we kind of said the lower end, let's say 81.25, 81.25, and we set a stop. What's that stop? We're just taking support less 2%, and that's going to get us 81.25 less 2%. It's going to be 79.62. So this is just going to be in the order to get in with a stop at 79.62. That's step one. Okay, let's show us how we're going to do it. We're going to right click on the chart, buy custom with stop. Now, you might be thinking, well, James, the last time the paper money account got into this, it lost. Yeah, what does that have to do with now? Not a whole lot. Okay, 79.62. So I'm going to put that right there. Dated GTC, there it is. Now, position size accordingly, okay? Now, the biggest thing is once we do that, we're going to go confirm and send, and now you're going to see there's a stop. Now, remember how the stop works. If it goes to that price or less, assuming that it was filled, the buy was, it's going to trigger the order to sell. Okay, now, and it could even be at a lower price. Now, this second order, this is really going to be a buy, stop, and I'm going to include limit for some of you that don't like having an uncapped order. That's fine. Buy, stop, limit, GTC. Now, why is someone doing a buy, stop? What are they trying to get? What are they trying to do? Okay, well, what they're trying to really do is they're trying to actually say, look, don't get in until we go to this price or higher. You're wanting to try to catch the momentum to the upside. Now, by the way, what I'm going to do, just for simplicity, is I'm going to say that buy stop price is no more than a quarter, okay? No more than a quarter above that price. So it says buy if we get to 86.56, but don't buy if it's more than 86.81, okay? So the first order, let me kind of put that back in that paper money account. We're going to bring it up, and let me just bring up me. And we'll kind of do this. We already did this first order, but I just want to put this on that paper money account in the IRA, 79.62. Okay. Dated GTC. Okay. Now, once we do that, that's the order. We already talked about this. That was the first order. Now, what we're going to do is we're going to right click on the chart again, or you can do it on the analyze the trade tab. We're going to go to buy custom. We're going to go to, let's say, with stop. And in this case, we're going to do limit to a stop limit. Okay. Now remember, that stop, okay, was we're saying, look, the price needs to go to 86.56. Now remind me, how did we get to 86.56? Well, that price is just taking the first entry, and I'll write this down so we can follow all along. This is just taking the first entry price plus one ATR. Okay? That's all it is. That's how we got it. Okay? First entry price plus one ATR. So we're going to type in 86.56. 86.56. Now, what happens if it doesn't go to that price? It doesn't fill. Okay? What's the cap? Well, we took this 86.81 That was the 86.56. Add just a quarter, and that's going to be the cap. Could it buy lower? Answer, yeah, sure. Okay. It just can't buy, 86.81. Okay. And then when we put that back on, 86.56. There you go. 86.56. There it goes. Dated GTC. I'm going to tell you what happens. Okay. Think about this psychologically. When the volatility goes up, people are scared. Okay. Now, and what happens is people become undisciplined. They don't understand that all stocks, all sectors, all industry groups are not the same. So you're kind of trying to play off or strategize that some investors might move to those areas that are less volatile. It doesn't mean that they can't go down. It just means that they're not as cyclical as technology or discretionary and so on. Okay. Now, for the stop, we're going to use the exact same stop we used on the first. Now, could those orders be combined if both orders were to fill? Sure. Okay. Now, what you're now going to see is we have a buy stop with a cap price, and then we have the stop order. Okay. Now, here's what we're going to do. We're going to go ahead and say confirm and send. Notice this in the paper money account. We got an entry price. That's a GTC again. And then we talked about how that stop works. We're going to send the order. Now, I want to ask you a quick question. How many of you have kind of, let's say, allowed fear to dictate what you're doing and you feel like you've missed opportunities in pullbacks? How many of you, besides Ben and I, have felt like that? Geez, maybe I shouldn't have been as fearful. Maybe I could have practiced dollar cost averaging and kind of using order types that if it were to bounce back to the upside, the investor could have maybe tried to ride that bounce and or that trend back to the upside. So the idea is we're not letting fear dictate. We're actually saying, hey, we're going to try to play a strategy. And the strategy is that if we see market go down, volatility goes up, we know that there's income stocks, there's growth stocks, and there's value stocks. And if we, for example, see that, let's say, markets drop, volatility goes up, we know that those investors might probably go to income areas. That does not mean that some of those growth stocks might not be at attractive levels, but it's probably a little early. Okay? Now, are there any questions? John, don't say I hate to admit it. See, everyone has to have some of their own experience. Okay, that's fine. Now, what I want to do is I want to take another spot, and what I want to do is I want to kind of pull up something, and I just want to kind of show you this, okay? Now, some of you know that, and I want to kind of talk about an example, okay? So what I want you to kind of recognize is here on this chart, and I want to bring up just one example, okay? So I think this could be helpful for you to manage existing positions. So trend, like as I talked about, if we see trend 5, we know we want to ask ourselves the question, do you have a stop? Okay. Have you adjusted the stop? Are you considering protection? Now would not be a bad time. Okay. Because you're losing momentum. Okay. And you're likely going to drop down to the next moving average and or support. Okay. Now, if we, for example, get to 1, that just means that we've dropped more severe. You're wishing you were probably exited out. You're saying, geez, I wished I had a stop, or how come it didn't trigger? Or if you're in 1, you're saying, wow, I've given back a lot of unrealized profits, or I'm even eroding some of my capital. Okay. If you're waiting to number 1 to finally ask those questions you want to ask yourself in 5, it means you probably weren't paying attention. Don't worry, I've done that too. Okay. Now, something that helps some of us is we've talked about on charts, and this is very important. I want to connect the dots. Okay. So let's say I bring up a stock example given Amazon. Okay. And I bring up a stock Amazon, and I'll share this chart and I'll share the scripts with you. Okay. So on this chart, what you're going to now notice is the following. Okay. We got a stock, Amazon, which was down $5 today. And tell me where we would say there was kind of not discipline here. Well, what you're going to notice is the yellow line was going up, 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 which represents the 5-day low over time. And yesterday, if you moved up your stop, that stop was probably right about 185 and change. Okay? Now, what's the problem? Well, now, since we made a new short-term 5-day low, that line is bent down. So one thing we want to do is once we realize we made a mistake, we did not move up the stop yesterday at the close. We want to, some investors might say, look, I'm not going to go down the road further down the road. I want to get out of the position. The stop, if the investor was moving up the stop, it would have been moved up to where that yellow line is, okay, from yesterday at the close. We're not moving down the stops. If that yellow line goes down, the 5-day low, it's plotting the 5-day low. That line is going down. That's like you taking off your seatbelt right before the car crash. Okay? So in this case, what you're going to notice is if this goes down in the morning, it should stop out, but you need to verify that it got filled. Okay? Now, the other thing about this, so first off, the yellow line is the 5-day low. And that gray line is the 10-day low. And you'll see that right up top. Let me share this with you. So this gives you a kind of another way to visually see this. Okay? So if you're holding on to stocks where the stock just day after day is hitting the 10-day low, 5-day low, hitting the 5-day low again, hitting both lows, hitting both lows, hitting both lows, you know that something happened in terms of discipline. Because if you're holding on to stocks where it's hitting day's lows, you probably never had an exit. You never adjusted the stop at all. You maybe never even considered the protection. The other thing is if those moving average lines are red, like there or there, this is just kind of like fire alarms going off, okay? Now, the other way I like to see this from a monitor perspective, okay? Now, notice on the market watch, it will also show 5DL. Now, wait, what does DL stand for? Just take a guess. Okay? So we know if we see that trend color go 5, we're like in an airplane, and the captain comes on and says, ladies and gentlemen, we've lost an engine. It's not funny, okay? But it's you know that maybe you better strap it up, okay? Now, you don't know if that engine is going to come back on, but the altitude is going to go a little lower, okay? Not a fun scenario. Now, if we take a look at this, okay, the 5DL is the 5-day low that's on the chart. So, in other words, if we were looking at Amazon and I said, hey, or let me take a different stock. Let's say Chevron. Let's say we have Chevron, okay, 100 shares, and the trade price was $151.73. The mark now is 150.47. And if we see that 5-day low at 148.97, we know we're only about $1.50 in terms of being stomped out. So the DL stands for day low. It's matching what's on the chart. Scripts are not guaranteed for accuracy, so verify. The DL right there, days low. Where's the 10-day low if you're using a lower stop? 140.63. So whether you want to use the monitor tab or you want to use the charts, it's kind of syncing it up. Okay. Now that sounds all great and good, but where it's kind of like, what do we need to be careful of? Well, if I look at this Chevron and say, oh, I'm fine, it's still good. The current stock price is above that 5-day low. I'm not stomped out yet. You need to verify that 5-day low has not bent down like we saw on Amazon. Now, when we look at, let's say in this case, Chevron, the 5-day low is increased. Guess what we need to do? We need to take that stop and say we're going to move it up to where that is and then send it back. Now, where we move the stop up to doesn't mean that's where the fill is, because that means that we have learned nothing, okay? The bottom line is that's just the trigger to sell. Have to see where the fill is, Okay. So I want to make sure that, and by the way, so when you go back to this, let me share these with you. Okay. So now, by the way, if you had, let's say, a portfolio, like on a watch list basis, you could also, for example, put those in the column headings. And to me, it's just a way to kind of see how close we are to the stops. So we could bring it up on a market watch quote page, and or we could bring it up on, let's say, the monitor page as well. Both. Let me share those with you, and then we're going to do two more examples, okay? So I'm going to right-click on this. Let me edit that formula, and let me send it to you. Now, this script is just saying, now, by the way, you can customize this. It's the shortest script ever, okay? It's just saying, what is the lowest day over the last 5 trading days? Share it with you. Now, if you said, I don't want 5, I want 8, okay? We'll put 8 in there, okay? It's about what you want, okay? And this one right here, I got to put that back in. Now, tell me what's kind of wrong with that. Well, I need to change that, and I'll just put 10 there. And by the way, that's all you're doing, okay? So if you want 20 or you want 10, 5, all you're doing is taking the number out, okay? Click on apply, okay? And what I'm going to do is I'm going to send that back out to you. Share, okay? Now, what you're now going to notice, and by the way, you can do it in a scan. So that's what's kind of fun. It goes all over the place. So just set those to you. The first one is the 5-day low. The second one is the 10-day low, okay? And now what you're going to notice is when I right-click on this, customize, when we put those scripts in there it is, and the 5-day low, we can see that and so on. When we go to the monitor page, okay, got to go to paper money where there's paper trades. If you said, I don't have this, this is on a new layout, okay, new layout. If you say, James, I'm on the old layout, don't want to be on the old layout, want to be on the new layout, okay? And if we do that, and you have some of the stocks broken down by what type of positions they are, et cetera, or sectors or whatever, just go to that little that little gear right there. Same idea. There's the 5-day low. And then we can go down to, let's say, 5. And there it is right there. So that's all it is. You're just moving it over on the monitor. That's a quick way to kind of know how close are you to being stomped out. Now, remember what we said, what's the danger in that? If that stock dropped down to a fresh 5-day low, like we saw on Amazon, it's not a bad thing to just double check that, as we did with Amazon and Chevron, okay? Now, that's what some of us like to use, okay? Now, what I want to do is I want to go back to the chart just real quick, and I want to pull up, just kind of show a couple stocks. Now, remember I said when you look at, let's say, real estate, okay? Now, let me disclose this. Real estate investment trust, okay? So we're talking, it is real estate, but it's just a product type, okay? And there's different risks associated with investing in real estate investment trust. Now, what I'm going to do is let me show a couple. And so we kind of see some pretty big bounces here in this area of real estate. Now, what's kind of interesting about this is kind of flag-like behavior and getting a little bit of a bounce. That's a short-term higher high with earnings coming up. Now, feel free to do this. When you went to Schwab.com and you pulled up the revenue, you pulled up the earnings, you pulled the dividend history, you'll see it's a lot more consistent on an average basis when you compare it to, let's say, energy or discretionaries. Avalon Bay, for example, when is its earnings? On the 5th, and that's had a pretty big bounce. Now, Ben actually teaches from time to time the class on fleegs. Now, fleegs is how Canadians say flags. If you're from the US, we would just say flag. Both are appropriate, okay? Now, some investors might say, okay, we had the prior high at right there. Now, that prior high also coincides with the middle of the green candle. Okay, where do we want to go now? Okay, well, where I would like to go, okay, we're going to do this order a little differently. So let's say we said, James, I like to get in if we come back down to the middle of the candle. So let's go back to our little sheet here, okay? So let's say we said, hey, look, we're going to look to get in the example of Avalon Bay. This was an area that, man, if you looked at anything in the S&P 100 or 500, would have been pretty hard not to see these real estate stocks get a little bump. Now, let's say that first entry, okay, that we're trying to get into is in the middle of this green candle, which also marks where that prior high was. So we're going to write down 227.32, okay? And if I type that in 227.32, if you said, James, I like to really buy on the dip, okay, fine. Buy, limit, GTC. That's it. Good till canceled. Doesn't have to be GTC. It could be day for you, okay? Now, the other thing is what we're going to try to do is if, for example, if we go back to the upside. So let's say tomorrow, if that stock, now what I'm going to do is I'm going to put a buy stop, okay, at like 230.23. Now, if you said, well, geez, where would I like to buy? The investor says, James, I'd really like to buy on the dip in the price. And the second one is if we take out today's high, it's going to buy half the position. Does that make sense? Okay. So now in this case is notice we're not using ATR in this per se because we're trying to buy the first entry on the dip. Now this is something else that happens to human nature. Now, you know that we kind of have a TV program that recently came out and it talked about trader psychology, right? And the person has asked the question, how do you exploit human weakness? And the person, okay, it was a funny question. So how do you exploit human weakness? Well, when things get a little bit more volatile, people don't tend to put orders out there. They're fearful. They want confirmation. And then they realize down the road the confirmation ain't free, okay? So what we're going to do is we're going to not let fear dictate. We're going to kind of go back to where might be an area of support. We're going to right click on the chart right in the middle, buy custom. We're going to go with stop. Now, what we're going to do is we're going to set a stop right underneath 223.70. 223.70. Stop is going to be sitting at 219.22. Put her right there. Okay? Now, dated GTC. Now, if someone said to us, you know, why is it when the market goes down and the volatility goes up, why do utility stocks tend to go up? Why does actually real estate stocks tend to go up? Sometimes why does healthcare go up? Non-biotech. Why do some staples tend to go up? Look at Walmart. Keep an eye on Costco. Keep an eye on Target. Well, because they're trying to buy companies that could be traded and or invested in potentially, okay? Because investors are trying to maybe get out of the way of the stocks or exit out of some of them that might be dropping. And they're trying to put some capital to work, maybe in the shorter term, okay? Now, what you're going to notice is we're saying, look, buy that if we get to the middle of the green candle. This will be limit day GTC. There's the stop, GTC. Now, in this example, just because I think the position size might be a little big, we're going to go 50 shares. We're going to go confirm and send. Now, if we take a look at this, now here, what's the bad part of this? The bad part of this is if the stock does not drop to that price or lower, it doesn't fill. So what are we trying to do to offset? Okay, well, what we're trying to do to offset is we're also trying to put an order, a buy stop. Can you think of the number of trades that you've missed in your life because you never had a buy order to the upside? Now that is so foreign to us. It is completely foreign. Why would I want to buy at a brand new high? Well, the joke I always say that is so applicable is why did you marry their spouse at an all-time high? Why did you marry them at their all-time high? Why'd you buy the house at a 2,000-year high? Why'd you buy the car, the brand new one, at a 100-year high? Why? Well, because if you married your spouse at an all-time high, you thought that if you combine, that you would take each other higher. I mean, I know that's what you thought. That's what I thought. Okay? Now, here's the deal. If that stock goes to that price, does that guarantee that the stock's going to go higher? No. But if the price gets to that point, that would be a shorter-term higher high. And if you make a higher high, the highest likelihood is, survey says, higher low. So if you make a higher high, you make a higher low, that equals what we call the definition of an uptrend. Ding, 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 ding. Now, I'm going to tell you right now, I think it took me, don't laugh when I say this, I think it took me 10 years to really understand trend. Okay? You could know definitions left and right, but until you prove it on the charts, it's just a definition. Okay? Higher highs, higher lows. Which stocks have you rode lately, proving that you know that? Okay? Now, if we look at this, we're going to take the other 50. So what happens if we don't fall back? Well, if we don't fall back and the stock shoots to the upside, this is the order trying to capture that upside punch. Okay? Now, could we also put a little target right the prior? Could. Okay? And that's going to about 235. But we're going to try to see if these can't bounce a little bit more than that. Okay? Now, if I look at this, we're going to put in 219.22. Now, what if tomorrow we come down in the middle, we fill, and then the stock bounces to the upside, and then we get filled on the second order? Could we combine those two stops? Sure. Okay? Cancel one and just adjust it for the full amount of shares now. Sure. Okay? Now, I want to kind of stop for just a moment, okay? So the overarching theme of what we really talked about is not letting fear dictate, okay? I've been saying for 2 weeks now, if the Japanese yen continues to go down, it's equity market supportive, meaning that if and when we have drops in the equity market, those pullbacks could be bought by some investors, causing the trend to maybe bounce up. That's what we're going to keep watching on. The yen did not go to the upside here today. The yen fell. Keep an eye on that. We call that the international VIX. Okay? Just because the volatility goes up a little bit doesn't mean investors are fearful of a bear market, for crying out loud. Okay? Now, here's the deal. The second thing we actually talked about is dollar cost averaging, using ATR to split up the entries. We did 2 examples of trying to buy if it went, we buy it at the current price, and then we add to it. Or we did this example, buy at a lower price and add to it if we take out a high. We showed both ways. The other thing we really talked about is being systematic in looking at days lows visually on the chart. And we also, for example, said, hey, we could take those days lows right on the market watch so we can see where we are, where's the current stock price relative to those days lows. But we could also see that and help us see it right on the monitor tab as well. The last thing that we really kind of wanted to make sure that we pepper is really, for example, having an understanding what the trend is telling us. When things start to fall, they tend to domino, meaning the majority of things go down. But in our discussion here today, we talked about that minority. What are maybe some areas that might not drop maybe as severely? They could still go down. They're correlated to the market as well. But what might be some areas where they might be more some interest of current market participants if they did not want to sell or they did not want to go bearish the market? Wonder if they're long-only investors. And I think that's what we're really seeing when we look at utility stocks here today. And by the way, I'll kind of fast fire through a couple stocks. When you look at even stock like Staples basis, like Kroger, okay, getting a little push here today. Now, Kroger is actually at the prior high, where this might be an example of a continuation pattern. Keep an eye on it. When you look at, let's say, Medtronics, little pokey here today, okay? You're also going to take a look at when you go into those utility names, not a bounce yet, but these are, for example, some stocks that could be right at a diagonal level resistance, where if they're going to break, probably going to know in the next day or two, are they really actually, and they've ran up and they've actually pulled back. And why in the world would you make a pullback so close to the resistance? Keep an eye on American AP. When you look at some of these other XEL, little bounce, look at Walmart, brand new high. If Walmart goes to the upside, you're probably thinking about Costco, okay? And Costco's right at a little trend line here with a very thin MACD, okay? So when you start diving into the markets, what you're really going to notice is there's quite a few names that are kind of, don't tell anyone, okay? But if you start looking at tech, discretionaries, that is more normal that when the volatility goes up and the market drops, those are more sensitive, cyclical to what the market does. Do not forget, that's not the whole entire market. This is why we want to talk about both sides, offense, defense. And that's a part of the game, okay? Now, I'm out of my time here. Hopefully this was helpful as we talked about this and also as we share those scripts as well. I want to say thanks to Ben Watson for answering those questions in chat. Also, if you don't know, Ben, if you could put that link in there of the upcoming workshops, Ben will be probably hitting the million miler status coming up in the next 2-3 weeks. And looking to come to an area nearby you for a live workshop. So stay tuned for that. Now, also just real quick, remember with what we discussed, it was done for example illustrative purposes only. We talked about different risk of different sectors, but also what might be some other areas to consider as an investor who is trying to trade growth and value stocks, but also maybe complement with income stocks during higher pockets of volatility. So we'll come back tomorrow on futures. Brett Morris will actually teach that. I'll come back on trend trading. Ben Watson will be on at 11 a.m. Eastern. So stay tuned. Thank you so much. Take care and have a great evening. Bye-bye.